When you think of a safe, reliable utility stock, Southern Company probably comes to mind. But what if that feeling of safety is actually blinding you to a really expensive price tag? Today, we're going to dig deep into the numbers to see if this is a genuinely solid investment or maybe an expensive trap. Let's figure it out. Okay, so we're going to tackle this with one very, very specific question in mind. See, the analysis we're breaking down today sets a really clear goal. Can we compound our money by at least 9% a year for the next 16 years with this stock? So everything we look at today, it's all going to be through that lens. Is it even possible for Southern Company to hit that target from where it's trading right now? And to get our answer, we've got a clear roadmap. First, we'll get to know the company itself. Then, we're going to put its price head-to-head with its actual value. After that, we'll do a deep dive into its real strengths and weaknesses, look at a few possible future outcomes, build an actual playbook with buy prices, and then finally, we'll deliver the final verdict. So first things first, let's start with the basics. Who exactly is Southern Company and, how do they keep the lights on, literally and financially? Well, they're a huge player in the utility space. We're talking millions of customers for electricity and gas all across the southeastern U.S., which, by the way, is a region that's growing pretty fast. Now, the key word here is regulated. That means state governments basically give them a monopoly and tell them how much they can charge. This lets them cover all their costs and, crucially, earn a predictable profit. It's a super stable business model, and this is a big but. Like most utilities, it is incredibly capital intensive. It costs a ton of money just to maintain and grow everything. All right, so we know what they do. Now for what might be the most important question for any investor. What is this business actually worth? And how does that stack up against the price on the ticket? First, the price. At the time this analysis was done, a single share of Southern Company would set you back $97. But here's where it gets really interesting. The analysis, which is based on the company's real cash flows and earnings power, puts its true intrinsic value at just $77. That's a $20 gap between the market price and the actual value. Understanding why that gap exists is the key to this whole thing. So where did that $77 number come from? Well, you can see at the top, it's a blend of a couple of different valuation models. But look a little lower. Check out the PEG and PGY ratios. These are flashing some serious warning signs. Generally, a ratio over 1 is considered kind of expensive, and here we're seeing numbers well over 2, even over 3. This tells you that the market is paying a really, really high premium for the company's expected growth. Okay, that big gap between price and value, that's our cue to really pop the hood and see what's going on with the company's fundamental health. We need to look at its core strengths and, of course, its weaknesses. And this right here really shows you the central tug-of-war happening with this company. On one hand, Southern's greatest strength is its government-guaranteed monopoly, right? You can't just choose a different electric company. That's a massive competitive advantage. But on the other hand, its biggest weakness is that it's constantly spending more cash than it brings in. That's called negative free cash flow. It means the company has to keep borrowing money or issuing new stock just to fund its projects and to pay its dividend. This chart really puts some numbers to that story. Check it out. At the very top, that regulated monopoly gets the highest possible weighted score, a perfect 1.00. I mean, that's powerful. But then, look down at the impact from capital intensity and leverage, all the money it has to spend and borrow. Those really drag the total score down to a 3.3 out of 5. It's good, but it's not exactly a slam dunk. So let's be super clear about what these red flags mean for an investor. First, the company is basically always spending more than it earns from its operations. Second, that dividend, the main reason a lot of people own this stock, is being funded with borrowed money or by issuing new shares, not by actual cash profits. And third, all of that debt makes the company really sensitive to changes in interest rates. Okay, so we've got the good, the bad, and the, well, not so great. Now let's shift gears and look to the future. What are some of the most likely outcomes for this company's valuation? We can really map out 3 potential paths here. Our base case, which is the most likely, lands right on that $77 value we calculated earlier. Then you have a bear case. Maybe interest rates go up and hurt the business. That could push the value down to around $65. But in a bull case, maybe things go really well and the value could climb up towards $88. All right, enough with the theory. This is where the analysis becomes actionable. Based on everything we know, what's the right price to pay if we want to hit our specific investment goal? Now, let's tie this all back to our original mission. That 9% annual return. Look at this table. To hit that 9% target over the next 16 years, the absolute maximum price you can pay is $70. Now, if you're okay with a lower 5% return, then yeah, you could justify paying up to $92. This shows you so clearly the price you pay is absolutely everything. And how long you plan to hold on makes a difference too. The longer your time horizon, the more you can technically afford to pay today and still hit that 9% return. But even with a super long 16-year outlook, the max buy price is still $70, which is a massive discount from its current price of $97. So let's just laser focus on this one number. For that 9% return we're shooting for, the magic number is $70, period. All right, we've looked at this from just about every angle. We've seen the business, the numbers, the risks, and the playbook. It is time to land this plane and deliver the final verdict. The conclusion from the source material is, honestly, crystal clear. If you already own the stock, it's a hold. Just keep collecting that dividend income. But if you're thinking about buying in, the advice is to stay away and avoid starting a new position at this price. So let's just boil this entire thing down. What we have here is a fantastic, stable business with a really powerful moat. Can't argue with that. But it's trading at a premium price that just doesn't line up with its real value. The risks from the high debt and the negative cash flow, they're real. And for our target, that 9% return, the math doesn't lie. You have to buy this stock below $70. And that is our deep dive on Southern Company. A really great business, but at a questionable price. So what other companies are you curious about? Let us know in the comments which stock you want us to put under the microscope in our next explainer.